who studied computer science from MIT, a Silicon Valley entrepreneur and founder of 1 Million by 1 Million, a global virtual accelerator with a vision to help a million entrepreneurs achieve $1 million in annual revenue and beyond, generate $1 trillion in global GDP, and create 10 million jobs. Her philosophy is rooted in bootstrapped entrepreneurship, a regular columnist in Harvard Business Review, Forbes, LinkedIn named her 2015 as one of their top 10 influencers. Please welcome Sramana Mitra. How are you, Shramanadi?
Very well, thank you. Good to be with you.
Thank you for your time. Today we will talk about virtual incubator, solo entrepreneurship, venture capitalists and their psychology behind. We will try to understand the ecosystem around VCs or ecosystem around that mentorship around those startups. These days you always talking about this is a golden age of solo entrepreneurship and ultra light startups. What makes this era uniquely suited building this kind of venture?
This is also the era of AI, right? So today, because of products like Lovable and Claude Code and various other vibe coding platforms like Cursor, Base44, etc., you can very rapidly build applications without having to do intense amount of coding. Now, I'm not saying that this is your final product necessarily, but you can at least prototype very easily, very quickly, very inexpensively, something that was not doable in the pre-AI era. In the pre-AI era, you needed either a technical co-founder or you needed to outsource your product development, MVP development to some outsourced shop or something. But today that barrier has become vastly reduced, which makes it easier for early stage entrepreneurs, including solo entrepreneurs, including non-technical founders, to very rapidly prototype and validate. And that makes this era the golden age of ultralight startups and solo entrepreneurship. I would add one more. It is also a golden age of non-technical founders.
So how these VCs or accelerator systems, they are seeing these solo founders, are they still open about it or they are still in that constipated mentality of team?
They're not very keen on solo founders. However, there is a caveat. Once as a solo founder, you have validated and you have a business that is rolling. Let's say you've bootstrapped your way to a validated business, a rolling business. That's when the bias against solo entrepreneurs starts to disappear. If you're trying to build a business as a solo entrepreneur, my guidance to you would be bootstrap your way to validation, bootstrap your way to, I would say, even profitability. And maybe it would make sense to go for investment at that point. As it stands, if you're out of the gate, if you try to join an accelerator like Y Combinator, you would most likely get rejected. Definitely, if you try to raise pre-seed financing without any validation work done, as a solo entrepreneur, you would get rejected. Now, the truth is, in these scenarios, whether it's going to Y Combinator or going to a pre-seed financing entity, even with a co-founder, most likely you're going to get rejected because Y Combinator has a 98% rejection rate and pre-seed financing has a 0.02% success rate. So we're talking about abysmally low probabilities. Y Combinator operates, as I said, on a 98% rejection rate basis, but it is promoting a startup building methodology that is basically blitzscale from the get-go. Before you do anything else, they're basically wanting you to sign up for hyperscaling. And they're teaching this methodology to the masses. Y Combinator Startup School is a very bad methodology. Tens of thousands of people are signing up for this startup school and learning a methodology that does not apply to them, and they're not going to be successful by applying that methodology. Y Combinator Startup School is a very bad methodology. It applies to a very, very small percentage of people who will be able to hyperscale their businesses. Vast majority of businesses out there are not going to be able to hyperscale from the get-go. They have this philosophy, go big or go home. That is very bad philosophy. The only scalable philosophy of building startups is the one that I teach, which is bootstrap first, raise money later, or not at all. We actually support entrepreneurs who bootstrap all the way, and we help people bootstrap to exit. These are all counterintuitive and contrarian philosophical premises based on which I've built 1 million by 1 million. Today, because we are in this golden age of ultralight startups, golden age of solo entrepreneurship, golden age of bootstrapped entrepreneurship, our methodology becomes extremely contemporary, extremely relevant, and extremely powerful.
Normally, the standard practice is 7 to 15% equity with all these accelerator programs, but you believe that the accelerator should not take any equity at all. That's a very brave statement.
Yep. Early stage equity is the most expensive equity. So if you're giving up 7 to 15% equity against very small amounts of capital infusion, you have out of the gate diluted your ownership in the venture tremendously. The sad part of that scenario is there is no guarantee that you are able to build a scalable, high velocity business, because those are really difficult to build. Very scalable, high velocity businesses are extremely difficult to build. The truth is 9 out of 10 venture funded startups eventually fail. They do not succeed in becoming high velocity success stories. Venture scale business, a successful venture scale business needs to go from 0 to $100 million in 5 to 7 years. And nowadays, because some companies, a handful of companies are growing really fast, they're going from 0 to 100 million in 3 years sometimes. So the investors are looking for these ultra high growth companies. The chances of your succeeding to build something that high growth that quickly is abysmally low. So before you validate your business, before you know whether your business can hit velocity or not, you have out of the gate diluted yourself 7 to 15%. And then what? There's a very good chance that you will never raise another round of financing because you will not hit that velocity. And unfortunately, if you're trying to build something relatively small and maybe not so fast growth, the success equation is very different. You want to build a high profitability company that creates a livelihood. And this is going to be so important in the current situation where layoffs are rampant. You're in Australia. You must have read about Atlassian's big layoffs in Australia. There's a tremendous amount of layoffs going on in the industry right now. I've seen some reports this year, the tech industry is going to see some 350, 365,000 layoffs. That's a very large number, and that number is going to keep escalating. From what we are seeing right now, from the trajectory that things are on, the number of layoffs are going to go up very significantly. Between 2026 and 2030, it's going to be a bloodbath in the technology industry and in white collar work in general, not just the technology industry, white collar work in general. If you agree with my premise that this is a very good time to create what we call a career lifeboat. Now, what is a career lifeboat? A career lifeboat is you start building a business, start validating a business on the side while keeping your job, as long as you have a job. If you've already lost your job, you need to start thinking about building a business full-time, not part-time. But if you have a job, I would strongly recommend that you start building a business and, what we call bootstrap with a paycheck. We've had a lot of success in the program of helping entrepreneurs bootstrap their startups with a paycheck. And that's a very smart, pragmatic strategy to create a career lifeboat, as I call it. Now, if you go that route, then basically what you're trying to build is a livelihood that is a self-employed livelihood. And in that scenario, you may not, even if you don't get venture financed, as long as you're making enough revenue and enough profits and you can sustain a good lifestyle for yourself and maybe a small team, that is a successful scenario. So please do me a favor and do not define financing as entrepreneurship success. Entrepreneurship is not equal to financing. Entrepreneurship is equal to customers, revenues, and profits, financing is optional. Exit is optional. Now, I mentioned earlier that we support bootstrapping to an exit. This is where the question of dilution becomes critical. The vast majority of exits in the technology industry is under $100 million exit value. And 96% of the exits are in that range, sub $100 million exits. And the vast majority of those are sub $50 million exits. And there are a lot of exits that you never hear anything about, $5 million, $10 million, $15 million exits. But if you start diluting a lot early on, then you don't make money of those small exits. The trick in making money and creating wealth out of small exits is to own your company 100% or close. So if you own 100% of your venture, and that is a perfectly successful scenario, $5 million, $10 million is a lot of money. So don't get confused by the yapping that goes on in the industry that you have to raise venture capital, you have to build a unicorn. No, you can build a successful business that is profitable and run that business for the next 20 years, and that's fine. That is success. You can build a small business that exits without raising any financing, bootstrapping to an exit. And let's say $5 million, $10 million, $15 million exit. That is also a success. So success has many, many different dimensions and many, many different formats. Venture capital financing and unicorn exit is not the only type of success. So please broaden your horizon, try to understand the discipline of entrepreneurship is far more complicated and far more nuanced than what this yapping of unicorn and venture capital has made it out to be.
Sitting in Australia, we don't have much visibility around these pre-seeds and seed investing. How success rate around this pre-seed or seed investing scenario? There should be like even lower.
0.02%. Pre-seed is incredibly low. And seed is a little bit higher, but not that high. So one thing Australia has actually done very well is bootstrapping. If you look at companies like Atlassian, it's a bootstrap company that raised money much later. It's a classic 1 million by 1 million philosophy. Bootstrap first, raise money later. Big Commerce followed that principle. There's a company called Destiny, I think, that I have profiled. We have the case study. E-commerce company called Shoes of Prey that did that philosophy. But then in some cases, they raised a lot of money from venture capitalists in the United States, and not all of them succeeded all the way because then they could not meet the requirements of venture capital financing. Shoes of Prey, for instance, did not become a successful company. They were very successful up to the point that they raised money. The minute they raised money, I think they were not successful in executing at that level.
What I can say is there is not much option also available in Australia other than bootstrapping. I'm also in that journey.
It's not a problem, though. I'm telling you, it's not a problem. Don't take it as a problem. Take it as an opportunity, because I think not having that option maybe gives you the right option, which is to bootstrap your way to a certain degree of validation and success and understanding of your business before you go out to scale and try to sign up for this hyper scaling, hyper growth kind of mode, which is extremely difficult to do. Remarkably few companies succeed in doing that.
Can you please explain or give us a real picture that a company, so after a profitable state, then they got some funding from VCs and then the whole thing gets screwed? What are the things go wrong there?
There's a case study that I teach, and I always say that this is a company called Nasty Gal. And this company did very well. They were bootstrapping, they were doing really well. They started as an eBay seller of vintage clothing, and then they bootstrapped their way up to a very high amount of revenue. And then they raised financing, a substantial amount of financing. And then they just lost the formula. They started opening stores here and there. And the beauty of a hyperscaler startup, something that really scales in a very high velocity mode, is repeatability. So if you have found a formula which is giving you high velocity growth, the only way you're going to succeed is if you scale that same formula. If you start changing formula, then you don't have validation. So Nasty Gal was doing fine as an e-commerce company, as a vintage clothing seller. The minute they started becoming hybrid, the formula was lost. The unit economics got screwed up, and they went out of business eventually. And there are many, many stories like this. Shoes of Prey, in fact, I think also is an Australian company that bootstrapped very far, raised money, and then they did not succeed in pulling off a full success story after that.
We have some misconception about this. When we are raising money, the startups are most likely building a product for the market. But most of the cases when you are bootstrapping, it's kind of a hybrid. Half of them is service, half of them is product or a project based. Like how you see this hybrid model going and
Yeah. We have a whole track in 1 million by 1 million that we call bootstrapping using services. Bootstrapping a product using services is a tried and true principle. We have case study after case study. There's a whole module full of case studies in the 1 million by 1 million curriculum that follows this path. We've had tremendous success using this path. There are principles that you need to follow of how you do this right. There are principles about how to negotiate intellectual property, price contracts. There's a whole bunch of things that you need to do right to be able to do this successfully. And you need to, stay focused on what kind of projects to take on. When you're trying to use services to build a product, you need to stay within your lane in which you want to, where your domain knowledge is and where you want to build the product. But it is very much a tried and true methodology.
And VCs are now opened. I mean, they understood this game now?
Not entirely. There are some things going on in the venture capital industry right now that has changed things a little bit, because a big, highly visible success story is Palantir. Palantir actually has used consulting-led growth. They have products, but they've also used consulting services very effectively. They do like $10 million consulting product and services deals and implement whole solutions, including for the US defense industry and so on and so forth. Done very well in government. So they've used this services-led model very, very well. So there is a slightly higher appreciation for what you can achieve with a services-led model. But bootstrapping using services is not necessarily looked upon in the same way until you have made that transition. So if you're bootstrapping using services, my recommendation is to bootstrap to the level where your product services revenue has flipped, where your product revenue is higher than services and there is repeatability and so on. Otherwise, they'll think, oh, you're doing just consulting projects. That is not a venture scale business, which is true.
There should be a product-led approach. Needs to be there.
No. There can be a service-led approach, but you just have to bootstrap to the point where the product is defined and you're starting to see the product being adopted. You will start as a services business. You never start as a product business. Bootstrapping using services as a methodology is a service-led methodology. The product emerges out of the services business, but you have to wait to go to investors until you find the product.
This whole fundraising game, okay, we started seeing it from Silicon Valley, and or because of it is Silicon Valley, all these names kind of popping up, Stanford, Harvard. Now, in today's era, from various ways, people are coming and being the face of something. It is social media influencer or YouTuber or maybe a sports. People are getting really big celebrities from them. When they are coming into the business for whatever reason, that credibility helping now to get more funding or to get a easier penetration into the market, or it's all like a flat pyramid?
It depends. If you have a big influencer platform, if you have huge influence in your niche, in your category, that makes distribution easier. You have a built-in distribution capability that investors do take seriously. If you're a fashion influencer, for example, and you have 5 million followers, it is not such a long journey for you to build an fashion e-commerce business on top of that 5 million following. You could easily put together an e-commerce business selling into your 5 million followers. That's the logic of it. It's like whatever product you're going to sell, if it aligns well with your following, that is one of the ways you can go to market. And that is a reasonably good go-to-market strategy. I mean, I don't think I could have done 1 million by 1 million without the name that I had as at the time, this is a long time ago, I started 1 million by 1 million in 2010. I started writing my blog in 2005. I had a Forbes column from 2007 onwards. So when I launched 1 million by 1 million, I had a name, I had a following and so forth. So, and then LinkedIn also became very big for me.
Yes, all this build up helps actually.
Yeah.
Let's say a profitable startup in a growth phase and they got a significant amount of funding. They raised fund more than they required and then they screwed.
Definition that I use is death by overfunding. Death by overfunding is if you raise a lot of money, the exit bar is very high. So let's say you raise $10 million. For everybody to make money off a $10 million fundraise, the company has to be valued quite high. You know, you need a $100 million exit. Now, if you raise $100 million, then the exit bar is $1 billion. Very few companies reach $1 billion valuation. And then there's this liquidation preferences buried in. And normally when you have large rounds of financing, there's like 3x liquidation preference, 2x liquidation preference. That means that before you as an entrepreneur make any money, the investors are going to make 2x or 3x. That's the definition of liquidation preference. So as you can see, the bar is going higher and higher before this can become a successful exit for everybody. So death by overfunding often is that people raise a lot of money and they try to go too fast. And often they go too fast on unvalidated strategies. Remember I said repeatability is the name of the game? You cannot achieve high velocity without repeatability, validated repeatability. Very often when people raise a lot of money, they go after things that are not validated. And they go invest a lot of money and waste a lot of money. And those are the scenarios where death by overfunding is quite a common occurrence. It's happened a lot.
Okay, so now we talked about this venture and the style of the venture. Now I'm coming to the individual side of things. Okay, as you have talked and worked with hundreds and thousands of entrepreneurs, what sets them apart? Their personal values or their characters?
The kinds of entrepreneurs I like to work with are entrepreneurs who have self-discipline and they can execute strategically. Because we have this saying in our program, we say, do not spray and pray. Do not spray and pray means that you have to position tightly and not leave it up to chance for things to happen. You cannot just throw everything against the wall and see what sticks. That's not how you build successful bootstrap ventures. Even if you raise money later, if the early stage has to be bootstrapped, that means you have to be very disciplined, very tightly positioned, and very precise. So we say practice target shooting, do not spray and pray. That means you need very sharp positioning and very sharp disciplined execution. That is the only way you can achieve a lot with very small resources, which is the name of the game. For most bootstrapped entrepreneurs, that is the name of the game. You have very small resources and you have to achieve milestones within very small amounts of resources. For that, self-discipline and being able to strategically think through things and execute really precisely, that's really what works very well. You know, if you're a very high ego person who doesn't like feedback, you want to boil the ocean, you want to bite more than you can chew, those are the kinds of entrepreneurs who routinely fail. Of course, there is a whole different type of entrepreneur, which is the Sam Altmans and the Elon Musks. They can raise money, but that's a different kind of entrepreneur. And there are very few of those, but they exist, and that's a different business. But that is not my business. That's not the kind of entrepreneurs we work with.
Where they are now, it's probably easy, but when they started, probably it was not like that.
Yes, there's some truth to that, but they've also come from a different era, right? Elon Musk is not a young man. Elon Musk is in his 50s. He's gone through many ventures and he started in the beginning of the internet, right? We are a generation of entrepreneurs who started at the very beginning of the internet. 1994 is considered the beginning of the commercial internet. That is the year Netscape went public. I was at MIT at the time as a grad student. That is the generation that built the internet. Our generation is the first generation of entrepreneurs who built the internet. Things were a bit different at the time. But today in 2026, things are very different. The business is very different. And now we are in the AI era. So there's another round of difference coming along. which we discussed early on.
We are almost end of our podcast. Talked about the business itself. We talked about the individual. Last thing I would like to ask you is what kind of industries, let's say top 3 or top 5, you think will flourish down the line?
Well, the one that I think is the most important industry in the AI era that should flourish is healthcare. I mean, today, healthcare is not accessible for the vast majority of people out there, right? There's abysmally low numbers of doctors available for vast swaths of populations in different parts of the world, whether you look at India or Africa or Asia, wherever. That scalability of medical help or medical services is something that AI could make a real dent on and can make healthcare services tremendously scalable. That's number one. Then there is another part of the healthcare industry, which I think is enormously promising, which is pharmaceuticals. So drug discovery, AI-enabled drug discovery, I think is going to flourish tremendously. Robotic surgery should be another very big domain that should flourish. I gave you 3 different sectors within healthcare that I think all of these are going to flourish tremendously. Now let's switch to education. Education is also in a very interesting place. There is a question looming, which is, what do you educate people for at this point? What do you educate children for? What do you educate college students for? What do you educate higher education students for? This question is going to evolve. Next decade, it's going to definitely evolve. For example, if coding becomes entirely done by AI, whole discipline of computer science graduates have nothing to do. This is all going to evolve. Once you figure out what to educate for, how to educate is going to become enormously powerful. So if you look at what Khan Academy is doing, for example, Khan Academy has a product called Khanmigo, which is personalized tutoring. Personalized tutoring is an incredibly effective way of teaching. One of the things that we have not talked about, which we should talk about, is the 1 million by 1 million AI mentor, which is personalized tutoring for entrepreneurs. We released it in September and it's doing great. So you can basically upload your slide deck, and for $30 a month, you can get unlimited access to Sramana Mitra's digital mind. We talked about solo entrepreneur. Well, you could be a solo entrepreneur. I could be your co-founder. If you have me in your pocket for $30 a month, I could be your co-founder, because the level of advice that I can give you through that AI mentor is incredible, because it's trained on all my mentoring sessions. 724th roundtable is what I did this morning. So 724 mentoring sessions. The entire 1 million by 1 million curriculum, all our case studies, all my writings, blogs, years and years, 20 years of writing, books, everything is in that AI mentor. So you basically can tap into my knowledge and get guidance on the basis of the 1 million by 1 million methodology. Not Y Combinator Startup School, which I think is going to give you bad advice. 1 million by 1 million methodology, which is what is more applicable to your situation, most likely. If you try to go big or go home, that is not going to work. You need to build a business step by step, and my digital mind AI mentor is going to train you on is how to put one foot before the other and start to walk before you can run. That is the way to build a business. That is an example of the kind of personalized tutoring, personalized coaching that you can get in many different domains. I'm doing it in entrepreneurship, but there's K through 12, there is any field, any domain, you can get that kind of learning.
Thank you, Sramana. Thank you for your time, and hopefully we can build a more sustainable and more happy future for our next generations.
Nice to meet you, Gautam. Bye.